Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMB in Manhattan, and welcome to our weekly options lesson. Today we're going to be talking about credit spreads and specifically the best way to optimize your return potential on a credit spread. A credit spread is basically a very forgiving way to play a directional viewpoint that you may have on a stock. And what's great about credit spreads is if you're right about direction, you will clearly win. If the market goes nowhere for that stock, you will win just as much as if you were correct about direction. Even if the market goes against you to some extent, depending upon how you put the credit spread together, you will receive a maximum profit on the trade. The scenario where you lose on a credit spread is where you were quite wrong about direction, and particularly if the market moves early after having put the credit spread on, then you can have some losses. So there's 3 of the 4 scenarios that I named. You make money on these trades, and that's why credit spreads are so popular. So let's take a look at an example of a credit spread. This is in Priceline. And Priceline, when we set up this example, was trading at 11.69. So if you put on a credit spread, what you would do, for example, is to sell the 1030 May PCLN put, and then you would buy protection below that, a long put at some point below that. In this particular example, that credit spread would earn you initially, or you would receive into your account, about $5,500 for that. So as you can see, the profit range for this PCLN credit spread is pretty much anywhere from 1030 up to infinity. And that means you have a 139 point drop from its current level for you to lose money on this if you held the trade until expiration day. So that would be a pretty healthy drop, but it's a stock that can move around, so it's certainly possible. And of course, you're not going to put this spread on if you believe PCLN will go down, because the safer direction, of course, for this stock is up. There's no upside number that can hurt you if you put this credit spread on. So you'd have to be bullish, but in this case, if you were right, you're going to pocket your entire $5,500. If the market just does nothing, you're going to pocket your entire $5,500. Here's the amazing part. If the market goes down more than 130 points, you're still going to pocket your full $5,500 if you hold it till expiration day. Now, whether that would be advisable under all circumstances, it would not be advisable in certain circumstances. If you hit your maximum loss, for example, your stop, you've got to get out even if it's above 1030. But the point is that if you were to hold it till expiration, you have a substantial opportunity to make a profit on this particular trade. So that's why people love credit spreads. They give you so much flexibility. You can be wrong and still make your full target profit. Now, what is a credit spread exactly? As I mentioned earlier, it's selling, in the example of a bullish credit spread, selling a put below the market and then buying a put even farther out of the market than the put that you sold. That is what is called a credit spread, because you're receiving a credit for it in your account. The one you're selling closer to the market will bring in more premium than what you will have to spend to buy the long. Thus, it is a credit spread. So you might say, all right, I've picked a strike that I think is pretty safe on the put side, but which long should I buy? And that is the question that we're trying to answer today. The long that you want to buy is the one that's going to give you the best return on equity. So let's give you an example here. Suppose you bought the PCLN long of 980 against the short of 1030 that we were just discussing. You would bring in about $6,600 if you had done that on the day we set this example up. Here's your profit range, and you can see your return for that credit spread would be 15%. Now, what if instead of buying the 1030, the 980 long, you bought the 1020 long? What if you did that? And the answer is you would bring in significantly less money because you'd have to pay so much more for the long at 1020 as opposed to the one at 980, so much farther out of the market. You'd only receive 1875, so you'd say, well, without knowing any other facts, you'd say, I think I'd rather buy the 980. But actually, that would not be correct because the return by buying the 980, excuse me, the 1020 is 23%. Now, why? Why did the return go up so high? And the answer is margin. When you enter into a credit spread, your broker will margin you. The margin when you have a 50-point strike separation between your short and your long is much, much larger than the margin for a small strike separation like 10%. So therefore, even though your numerator of your return calculation is a lot smaller by buying the put closer to the short, your denominator is even more small. In other words, your denominator is so small that it makes your return for the transaction go way up. So actually, from a return standpoint, you are far better off buying the more expensive put because your broker will margin you less. So in this particular example, the denominator, the numerator, of course, was 3.5 times larger with the wider spread. But the denominator, the margin eaten up, which is how you calculate your return, is 5.3 times less with the tighter put as opposed to the wider put. So therefore, you actually are better off spending more money for the long put that is closer to the short. So what's the moral of the story? The best return on a credit spread is not determined by the amount of cash you receive, but it's the amount of cash, it's the ratio of the amount of cash divided by the capital eaten up by that particular spread. And in most cases, typically, and you need to check this, so this is not going to be true 100% of the time, but in most cases, the closest strike to your short actually is the one that's going to give you the best return for your capital, and that's the one you should buy if you're being economically rational about it. So that's our lesson for this week. The closest long on a credit spread is generally speaking going to give you the best return, and that's typically what most good options traders will do. So that is how you should make the decision. The short should be determined by a lot of things, but certainly your view of the market and your view of what is a safe place to put that short, because you don't want the market to get anywhere near that short. But the long, that is the governor on your return, and typically that's going to be best when you get close to that short. So thank you very much for your attending our weekly options lesson today. If you have any questions, I'd be more than delighted to answer them at sfroidberg@smbcap.com, and just contact me and reach out and be happy to answer any questions you have. Thanks so much, and we'll see you next week. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.